You know what's strange about precious metals? Everyone wants to own them when they're afraid, and yet almost nobody knows how to think about them correctly. Gold hit record highs in 2024. Silver followed, though not quite to the same degree. And now, in February 2026, the question people are asking is not whether to own precious metals. It's which one is the better bet right now, gold or silver, the safe choice or the volatile upside play. The thing is, that framing is already wrong. Because the real question isn't which metal wins this month. It's whether you understand what these assets actually do in a portfolio, and whether the current environment justifies holding either one at all. Let's start with what gold and silver actually are. Not what they feel like. Not what your uncle says about them at Thanksgiving. What they are, financially. They're non-yielding commodities with industrial and monetary roles, priced in dollars, traded globally, and influenced by currency movements, inflation expectations, geopolitical risk, and real interest rates. They don't produce cash flow. They don't compound. They sit there. Their only value to you as an investor is price appreciation or depreciation relative to what you paid, adjusted for opportunity cost. That last part matters more than people think. When you buy gold at $2,700 an ounce or silver at $30 an ounce, you're not just betting those prices go up. You're betting they go up more than what you'd earn in a treasury bond, or an S&P 500 index fund, or even a high-yield savings account. Because every dollar in gold is a dollar not deployed elsewhere. Opportunity cost isn't abstract. It's the return you didn't get because you chose safety over growth, or speculation over compounding. Right now, in February 2026, the macro environment is what I'd call unstable but not collapsed. Inflation has cooled from its 2022 peaks, but remains above the Fed's 2% target in most developed economies. Central banks have paused rate hikes but haven't aggressively cut yet. Geopolitical tensions remain elevated. Ongoing conflicts, trade friction, debt ceiling concerns, election uncertainty in multiple regions. The dollar is strong relative to most currencies, but not surging. Real yields, meaning the yield on government bonds after inflation, are positive but narrow. Equity markets are near all-time highs, but showing signs of valuation strain and increased volatility. In this context, gold and silver behave differently. And understanding that difference is the entire game. Gold is the monetary hedge. It's not an inflation hedge in the short term. That's a myth people repeat without checking the data. Gold performs best when real interest rates are low or negative, when currency debasement is a real concern, and when investors lose confidence in central banks or governments to manage debt and monetary policy responsibly. It's a store of value in the absence of trust. When people say gold is insurance, what they mean is it holds value when paper assets don't, specifically when inflation rises faster than nominal yields, or when systemic risk makes bonds and equities feel unsafe simultaneously. Let's put numbers to this. From 2000 to 2011, gold went from around $280 an ounce to over $1,900. Why? Because real interest rates were negative or near zero for most of that period. Central banks were expanding balance sheets aggressively, and post-2008, trust in the financial system was at historic lows. That's an annualized return of roughly 18% for over a decade. Compare that to the S&P 500 during the same period, which basically went nowhere after two major crashes. Gold won that decade because the conditions favored it. But from 2011 to 2015, gold dropped from $1,900 to $1,050, a 45% decline. Why? Real yields started rising. The Fed began tightening. The dollar strengthened. Equity markets recovered. The fear trade unwound. Investors rotated out of gold and back into assets that actually generate returns. That's the fundamental truth about gold. It only wins when alternatives look worse. Silver is different. It's half monetary, half industrial. About 50% of global silver demand comes from industrial applications, solar panels, electronics, medical devices, batteries. The other half is investment and jewelry. This dual role creates a strange dynamic. When the economy is strong, industrial demand for silver rises, which supports the price. But when the economy is strong, investors don't want safe havens. They want growth assets. So silver gets pulled in two directions. It has more volatility than gold, more cyclical sensitivity, and a much smaller market. The entire above-ground silver market is worth maybe $40 billion. The gold market is worth $15 trillion. You can move silver with relatively small capital flows, which means it can spike hard and crash hard. Historically, silver's price ratio to gold averages somewhere between 51 and 70.1. Right now, in February 2026, it's hovering near 85.1. That means it takes 85 ounces of silver to buy 1 ounce of gold. Some people look at that ratio and say silver is undervalued. Others say it's reflecting reality, that industrial demand is weak, that investors prefer gold's liquidity, and that the ratio is simply repricing based on fundamentals. Both could be true. Here's what the math looks like. If you bought gold at $2,000 an ounce in mid-2023 and sold at $2,700 in late 2024, you made 35%. If you bought silver at $23 an ounce at the same time and sold at $32, you made 39%. Silver outperformed slightly, with significantly more volatility along the way. But over longer periods, gold tends to provide smoother returns with less drawdown risk. Silver gives you higher beta, more upside in a rally, more downside in a sell-off. So which one wins in February 2026? The answer depends entirely on what you think happens next. If you believe real interest rates stay elevated, inflation continues to decline, the Fed holds steady or cuts modestly without panic, and equity markets stabilize, then neither metal is likely to outperform. Gold would probably range trade. Silver would underperform as industrial demand weakens relative to speculative interest. Your money would compound faster in bonds or dividend-paying stocks. If you believe we're heading into a recession, central banks will cut aggressively, real yields will collapse, and fear will dominate investor sentiment, then gold is the better hold. It will act as a flight to safety asset. It will hold value while equities and corporate bonds sell off. Silver might rally too, but it would lag because industrial demand would crater in a downturn. You'd want the pure monetary play, not the hybrid. If you believe we're entering a reflationary environment, fiscal stimulus, commodity supercycles, supply shortages, green energy build-out driving industrial metal demand, then silver has the edge. It benefits from both the safe haven bid and the industrial demand surge. In that scenario, silver could outperform gold by a wide margin. But here's the uncomfortable truth. Most people buying gold or silver right now aren't making any of those macro calls. They're buying because they're anxious, because the news feels bad, because someone on YouTube told them the dollar is collapsing, or because their father-in-law has been stacking silver bars since 1997. They're not thinking about real yields or supply-demand fundamentals or opportunity cost. They're buying emotional insurance, and emotional insurance is expensive. Let's say you put $10,000 into gold today at $2,700 an ounce. You're buying roughly 3.7 ounces. If gold goes to $3,000 by the end of 2026, you make $100 or an 11% return. That's the opportunity cost. Every dollar in gold or silver is a dollar not compounding. And compounding is the most reliable force in finance. It's not flashy. It doesn't protect you from catastrophe. But it builds wealth steadily, predictably, and with far less psychological volatility than watching commodity prices swing 15% in a month. So why own precious metals at all? Because portfolios need balance. Because diversification isn't about maximizing return. It's about minimizing regret. A small allocation to gold, say 5% to 10% of a portfolio, acts as a hedge against scenarios where your other assets fail simultaneously. It's not there to make you rich. It's there so that if inflation spikes, currencies devalue, or systemic risk materializes, you don't lose everything at once. It's optionality. It's paying a small premium for asymmetric protection. Silver plays a similar role, but with higher risk and reward. If you believe in the industrial demand thesis, solar energy scaling, electric vehicles proliferating, supply constraints tightening, then a small position makes sense. But it's speculative. You're betting on a narrative, not buying insurance. And speculation requires conviction, research, and the stomach to handle volatility. The people who win with precious metals are the ones who buy when nobody wants them and sell when everyone does. Gold bottomed under $1,100 in late 2015. If you bought there and sold in 2020 at $2,700, you nearly doubled your money. But most people didn't. They bought at $1,800 in 2011, held through the crash, and either sold at a loss or held for a decade waiting to break even. They let emotion override strategy. They treated gold like a lottery ticket instead of a tool. Right now, gold is near all-time highs. Silver is elevated but not euphoric. Sentiment is cautious bullish. That's not a screaming buy signal. It's a market that's priced in a moderate level of fear and uncertainty. If that fear escalates, prices could run higher. If it dissipates, prices will correct. The edge isn't in picking the metal. The edge is in reading the environment and acting accordingly. If you're sitting on cash right now, trying to decide between gold and silver, ask yourself what you're actually trying to accomplish. Are you hedging against a specific risk? Are you speculating on a macro trend? Are you just nervous and looking for safety? Because those are three different strategies with three different position sizes and three different time horizons. If you're hedging, buy gold, keep it small, 5% to 10%, and don't check the price every day. Let it sit. If you're speculating, silver offers more upside but requires tighter risk management. Set entry and exit points. Don't fall in love with the position. If you're just nervous, buying gold won't fix that. It'll just convert your cash anxiety into price anxiety. You'd be better off building a plan that addresses the root cause of the fear, not the symptom. And here's the thing people miss. Precious metals don't make you financially free. They don't generate cash flow. They don't buy you time. They don't build systems or create leverage. They sit in a vault or an ETF and wait for the world to get worse. Real wealth comes from assets that compound. Businesses, real estate, intellectual property, skills that increase your earning power. Gold might protect what you have. It won't build what you need. So which one wins in February 2026? Neither, probably. Or both, depending on what happens. The market doesn't care about your prediction. It cares about what central banks do, what inflation does, what geopolitical events unfold, what industrial demand looks like 6 months from now. You can't control any of that. What you can control is how you think about these assets, how much you allocate, and whether you're making decisions based on strategy or fear. The real question isn't gold versus silver. It's whether you understand the difference between insurance and investment, between speculation and accumulation, between reacting to headlines and building a plan that survives them. Most people get this wrong. They chase the metal that's already moved. They over-allocate out of panic. They sell at the bottom when they need cash, and they end up with neither protection nor returns. If you want to own gold or silver in February 2026, own them for the right reasons. Own them as part of a balanced portfolio. Own them with clear rules for when you buy more and when you sell. Own them without expecting them to save you. Because they won't. What saves you is consistent income, disciplined savings, intelligent deployment of capital, and the compounding of real assets over time. Everything else is just risk management. And risk management doesn't make you wealthy. It just keeps you from being wiped out while you build.